The worst economic nightmare isn't a recession. It's when you can't fix the recession without making everything else worse. That's stagflation. And right now, more economists are using that word than at any point in the last 40 years. Most people think inflation is bad. Most people think unemployment is bad. But those two problems have a built-in relationship. When one gets worse, the other usually gets better. That's the deal the Federal Reserve has worked with for decades. Raise rates to cool inflation. Lower rates to boost jobs. It's not elegant, but it works, most of the time. Stagflation breaks that deal entirely. You get rising prices and rising unemployment and a stagnant economy hitting you at the same time. And the Fed's standard tools? They don't just stop working. They actively make things worse. Cut rates to fight unemployment and inflation explodes. Raise rates to fight inflation, and unemployment climbs even higher. You're trapped. The economy is trapped, and the people living in it, people like you and me, get crushed from every direction at once. The last time America was deep in this, it took a decade to get out, and by the time it was over, millions of people had lost their savings, their jobs, and their faith in the economy entirely. Here's exactly what stagflation does to a country, and what it does to the people inside it. To understand why stagflation is so uniquely brutal, you have to understand why it wasn't supposed to be possible. For most of the 20th century, economists believed in something called the Phillips curve, a tidy, almost mathematical relationship between inflation and unemployment. When inflation went up, unemployment went down. When unemployment went up, inflation came down. The economy would find its balance. There was always a trade-off, but there was always a lever to pull. Then the 1970s happened, and the entire framework fell apart. It didn't start with one event. It started with a slow accumulation of bad decisions and bad luck. Vietnam War spending had been pumping dollars into the economy for years, running up deficits, and quietly stoking inflation long before most people felt it. Then, in August 1971, President Nixon made a move that would reshape the entire global financial system. He ended the convertibility of the US dollar to gold, what economists call the Nixon shock. Almost overnight, the dollar was no longer anchored to anything tangible. The US could print more money, and it did. 2 years later, the oil embargo hit. In October 1973, Arab oil-producing nations cut off oil exports to the United States in retaliation for American support of Israel during the Yom Kippur War. Oil prices went from roughly $3 a barrel to nearly $12, a 300% jump, almost overnight. Gas lines stretched for miles. Heating bills exploded. Every single product that used petroleum to manufacture or ship got more expensive all at once, which in 1973 was basically everything. And here's the thing about an oil shock. You can't fix it by adjusting interest rates. The price of oil went up because of a geopolitical decision made in Riyadh, not because American consumers were spending too freely. The Federal Reserve was being asked to fix something that wasn't a monetary problem. And every time they tried, they made something else worse. By 1974, inflation had climbed above 12%. Unemployment surged to 9% in May 1975. The economy shrank, and the Fed was standing there with a hammer, staring at a problem that wasn't a nail. Now zoom out and look at what was happening to actual people. Not economists, not policymakers, but ordinary Americans trying to pay their bills. Real wages collapsed. Not in a dramatic crash, but in a slow, grinding erosion. Your paycheck said you were making more, but everything you bought cost more faster than your income was going up. In 1973, the average hourly wage was $4.03. That sounds laughable now, but the key isn't the number. It's what that number could buy. And year after year through the 1970s, what Americans could buy with their paychecks shrunk. Middle-class workers who had done everything right, steady jobs, savings account, company pension, watched their real standard of living slide backwards. Savings accounts were a trap. If you had money sitting in a bank earning 5% interest but inflation was running at 10%, you were losing 5% of your real purchasing power every year. People who were responsible, who saved diligently, were effectively being punished for it. The money was technically there. It just bought less every single year. Bonds got slaughtered. Traditional fixed-income investments, the safe stuff your parents told you to hold, paid a fixed interest rate. When inflation runs hotter than that fixed rate, you're losing money in real terms on every payment. Bonds became one of the worst places to put money during the 1970s, and millions of Americans with conservative portfolios didn't even realize the damage until it was done. In stocks, the S&P 500 posted nominal gains in the 1970s that looked acceptable on paper. But strip out inflation, and the picture was devastating. In real inflation-adjusted terms, the S&P 500 lost nearly 50% of its value across the decade. If you had $100,000 in stocks at the start of the 1970s and left it alone, by the end of the decade your money was functionally worth about $50,000 in purchasing power. Investors who thought they were building wealth were actually watching it evaporate. The only thing that worked, and this is critical, was hard assets. Gold went from around $35 an ounce in 1970 to $850 an ounce by 1980. That's not a typo. A 2,300% run in nominal terms over 10 years, with real annual returns of roughly 9% after inflation. Commodities as a whole, oil, wheat, copper, lumber, all surged alongside it. The S&P GSCI Commodities Index returned over 500% during the 1970s. Real estate held value. Things you could touch, things with physical scarcity, things that didn't depend on a promise, those held up. And that's the stagflation playbook that history recorded. Paper assets lose. Hard assets win. Knowing this doesn't make it painless, but it makes it survivable. Now let's talk about how it ended, because the ending is as important as the story. By 1979, inflation was accelerating again. A second oil shock hit when Iran's revolution cut global supply and oil prices doubled again. Inflation hit 11% in 1979, then 13% in 1980. By March 1980, it peaked at 14.8%, the highest rate of inflation in the post-war era. The economy felt like it was on fire and drowning simultaneously. President Carter appointed Paul Volcker as Federal Reserve Chairman in August 1979, and Volcker did something that almost no one in modern American history has had the nerve to do. He deliberately caused a recession to kill inflation. He raised the federal funds rate, the rate at which banks lend to each other overnight, from 11.2% when he took over to a peak of 20% in June 1981. 20%. When people today argue about whether the Fed should raise rates a quarter point, remember that number. Volcker pushed rates to 20% and held them there. Mortgage rates went above 18%. Farmers couldn't afford the loans to plant their crops. Businesses couldn't borrow to stay open. The construction industry collapsed. Two recessions hit back-to-back, 1980 and 1981 to 1982. Unemployment climbed to 10.8% by late 1982. Farmers drove their tractors to Washington and circled the Federal Reserve building in protest. Volcker received death threats. Members of Congress called for his resignation, but he didn't move. And it worked. By 1983, inflation had dropped from nearly 15% to 3.8%. The pain had been severe, deep, and deliberately inflicted. But the alternative, letting inflation become permanently embedded in the American economy, would have been worse. Volcker made a brutal calculation, and history vindicated him for it. The lesson isn't that raising rates fixes everything. The lesson is that stagflation has no clean solution. Every exit costs something. Either you accept years of economic decay living with it. So where does that leave us right now? The word stagflation got serious traction in 2025 and into 2026. Not because conditions are identical to the 1970s. They're not yet. But because enough of the warning signs are lining up in ways that can't be ignored. Inflation, after appearing to cool through 2023 and early 2024, proved stickier than almost every forecast predicted. Core inflation is projected to run as high as 3.5% by mid-2026. Meanwhile, GDP growth has slowed, with most forecasters placing 2026 expansion below the 2% trend rate that signals healthy forward momentum. Unemployment climbed from 4.1% to 4.4% in 2025 and is expected to plateau around 4.5% through 2026. Not a crisis, but a meaningful softening of the labor market. And then there are the tariffs. The current tariff regime, fully implemented through 2025, is projected to raise consumer prices by roughly an additional 1% over the first half of 2026. What makes tariffs particularly stagflationary is exactly what made oil shocks stagflationary in the 1970s. They raise prices through supply constraints, not demand. When goods cost more because of a trade policy decision, the Fed can't fix it by adjusting interest rates without causing collateral damage to the job market. Economists are calling it stagflation light, a less acute version of the 1970s crisis, but one that follows the same structural logic: growth slowing, inflation sticky, the Fed's standard tools constrained. The phrase trapped keeps coming up in policy discussions. Whether this becomes a full stagflationary cycle or gets contained is genuinely uncertain, but uncertainty is not the same as being unprepared. And this is where the practical question becomes the most important one. What do you actually do with your money when stagflation is either here or approaching? First, reassess what you think is safe. Cash sitting in a savings account yielding 4% when inflation is running at 3.5% is barely breaking even, and if inflation picks back up, you're losing ground quietly. Low-yield bonds with fixed coupons face the same erosion. Safety, in a stagflationary environment, is not what it looks like on a bank statement. Second, look at Treasury inflation-protected securities, or TIPS. These are U.S. government bonds, where the principal adjusts automatically with the CPI. If inflation rises, your principal rises with it, and your interest payments, calculated on that adjusted principal, rise too. They're not high-yield instruments, but they remove the inflation erosion problem from your bond allocation entirely. When stagflation concerns were running high in 2023, TIPS funds saw massive inflows precisely because investors remembered what fixed-rate bonds did in the 1970s. Third, commodities and real assets deserve a seat at the table. Not necessarily gold bars in your closet, but exposure through ETFs tracking commodity indexes, energy sector equities, or REITs tied to physical real estate. During the 1970s, while stocks were losing half their real value, real estate delivered roughly 4.5% real annual returns, and commodities returned over 500% nominally. The principle, hard assets outperform paper promises during inflation, has held across multiple cycles. Fourth, if you're employed, your income is your most critical inflation-fighting asset. In a stagflationary environment, wages often lag inflation, meaning you need to actively fight for raises, negotiate anchored to current CPI data, add income streams, or build skills that keep your earning power ahead of the price level. Waiting for cost of living adjustments that may never come is exactly what crushed middle-class workers in the 1970s. Fifth, equity is still worth holding, but sector matters enormously. Energy stocks, materials companies, and commodity producers historically outperform during inflationary periods. Consumer staples, companies that sell things people buy no matter what the economy is doing, tend to hold up. Growth stocks with long-duration cash flows, on the other hand, get hit hard when interest rates stay elevated. The S&P 500 isn't one monolithic bet. Where inside it your position makes all the difference. One more thing, and this might be the most counterintuitive point in all of this. In the 1970s, the people who fared worst financially weren't necessarily the ones with the least money. They were the ones who did nothing, who assumed the economy would correct itself, who kept their savings in fixed instruments because that's what they'd always done, who waited for normal to come back. Normal didn't come back for a decade. And by then, the erosion was already done. Stagflation punishes passivity. It rewards people who pay attention, adjust their allocations deliberately, protect their purchasing power actively, and don't wait for a central bank to rescue them. Because as Volcker proved, if the Fed does step in to kill inflation, the medicine is almost as painful as the disease. Here's the question I keep coming back to. If a slow-motion decade of stagflation started right now, would your current financial setup survive it? Not thrive, just survive. Because most people in 1972 would have told you they were fine too. So drop your answer in the comments. Do you think the US is heading into stagflation, or do you think it gets contained before it gets worse? I want to know where you actually stand on this. If this video gave you a new way of thinking about what's happening in the economy right now, hit that like button and share it, because most people are still treating inflation and a slow economy as separate problems, and understanding how they interact changes everything about how you prepare. Make sure you're subscribed, because next week we're going deep on exactly which specific assets perform best in every recessionary and inflationary cycle since 1960. And the answer is going to surprise you. The 1970s taught us one thing above everything else. The economy does not owe you stability. Plan like it might not give you any.